Remember the 2008 financial crisis, the one where Wall Street's experts nearly imploded the global economy? Yeah, that one. It was a wake-up call for many, highlighting the need to take control of our own financial destinies. Enter the world of DIY portfolio management. Forget those slick suits and jargon-spewing analysts. You can be the master of your money. Why bother, you ask? Well, firstly, it's empowering. You call the shots, picking investments that align with your goals and values. Secondly, it's cost-effective. Ditch those hefty management fees and keep more of your hard-earned cash. Finally, it's educational. You'll gain a deeper understanding of the financial markets and become a more informed investor. So buckle up and get ready to embark on the exciting journey of managing your own portfolio. Think of it as a treasure hunt, with financial freedom as the ultimate prize. Before you start throwing darts at stock tickers, let's lay some groundwork. First things first, define your financial goals. Are you saving for retirement, a dream vacation, or your child's education? Knowing your destination helps chart the course. Next, assess your risk tolerance. Are you a thrill-seeking roller coaster enthusiast or a cautious merry-go-round rider? Your risk appetite will influence your investment choices. Now let's talk about time horizon. This is the period you plan to stay invested. A longer horizon allows for a more aggressive approach, as you have time to ride out market fluctuations. Conversely, a shorter horizon calls for a more conservative strategy. Finally, consider your financial situation. How much can you realistically invest? Remember, consistency is key, so start small and gradually increase your contributions over time. With a solid foundation in place, you're ready to start building your investment house. Think of your portfolio as a house. Asset allocation is the blueprint that determines the structure. You wouldn't build a house with only walls or only a roof, right? Similarly, a diversified portfolio includes various asset classes such as stocks, bonds, and real estate. Stocks offer growth potential but come with higher volatility. Bonds provide stability and income but with lower returns. Real estate can offer both income and appreciation but is less liquid. The right mix depends on your risk tolerance, time horizon, and financial goals. A young, aggressive investor might have a higher allocation to stocks, while a retiree might favor bonds for income and stability. Remember, diversification is your friend. It helps spread risk and smooth out the bumps in the market. Now let's dive into the exciting world of stock picking. Forget the image of a frantic trader yelling into a phone. Stock selection is about research and analysis, not gambling. Start by identifying companies with strong fundamentals, such as a solid track record of earnings growth, healthy financials, and a competitive advantage. Look for companies with a bright future operating in growing industries with innovative products or services. Don't be afraid to dig deeper. Read annual reports, listen to earnings calls, and follow industry news. Understand the company's business model, its competitive landscape, and its growth prospects. Remember, you're buying a piece of a business, not just a ticker symbol. Think like an owner, not a gambler. And there you have it. If you are ready to invest long-term, remember, even successful investors get lucky sometimes. But don't rely on chance. Be an owner and make informed decisions.